Welcome everybody to SF Live. Is the world collapsing? Are we drifting into a global recession? Is gold and silver the only savior that we have? I've got a fantastic guest for this episode today. It's Alastair Macleod. He's the head of research at Goldmoney. Can't wait for the discussion to happen. I think he's got lots of useful information to share with us. Just had a chance to chat with him briefly before hitting that record button. I think it's going to be a doozy. So make sure to stay tuned for this. And if you like our conversations, make sure to follow us on YouTube, follow us on Twitter, hit that like and subscribe button, leave a comment. Helps us tremendously with the algorithm if you like the information provided. And as you know, it's just financial information and education. There's obviously no investing advice associated, so make sure to do your own due diligence, obviously. But I think we'll give you some good tools and to make some better informed decisions and get an understanding of what is happening in the global economy and in the world right now, and maybe to protect some of your capital as well. Alastair, it's great to have you on the program. Thank you so much for joining us.
Nice to be here, Kai.
Yeah, no, it's great. I talked to your colleague, James Turk, the other day, and he strongly suggested to invite you on the program, and really excited for this conversation now here in the next 20, 25 minutes to get your thoughts, because why don't we dive just right in, because I just read an article that you put out on Goldmoney, and the title was, "Is the Crisis, or the Crisis is Upon Us?" It's pretty definite, and it sounds like a title suggests a lot of doom and gloom, but let's talk facts here. What do you see breaking, and where are things headed? Like, let's start with the breaking points.
Well, the whole system is fragile. And I think the underlying problem is that we have moved from a period of continually declining interest rates to a new period where interest rates are rising. And I think they will continue to rise. They've got a lot further to rise. I mean, you've just got to look at where the central banks have interest rates at the moment and compare that with the rate of increases in consumer prices in most jurisdictions. The gap, I think, is as large as I've ever seen it. I mean, you know, the idea that 2.5% interest rates are sufficient in somewhere like America or the UK, and even less, I'm afraid, in Germany and the rest of the EU, that's synonymous with rates of consumer price inflation exceeding 10% in many cases, and also producer price increases running and, you know, sort of 30%, that sort of level. Of course, what happens is that it's justified by central banks, by government statisticians saying that this is temporary. It's you know, it's going to come back to 2% because that's our target. We say it's 2%, so it will be 2%, you know. I'm sorry, this is complete rubbish. It's a totally changed environment. We're actually now in a war situation, if I can sort of switch the emphasis slightly, which basically means that the whole concept of global supply chains is undermined. And you know, I mean, supply chain problems is one of the things that central bankers and governments say will go away. No, it won't. Now that we're in fundamentally a war situation, I mean, it's a Cold War, if you like, or warm war, or however you like to describe it in terms of temperature. If you've got a supply chain that goes into your enemies, then I'm sorry, you're not going to resolve your supply chain problems in the foreseeable future. And by the foreseeable future, I mean in the next 10, 20 years, unless there's suddenly an outbreak of peace. But I think we've got to discount that probability. Supply chains have to return home, or at least to, if you like, nations which are friendly to you. And our friendly nations are all high-cost bases. So you know, the idea, I mean, you know, the very, very sort of concept, if you just dismiss monetarism, if you like, you know, the relationship between the quantity of money and the effect on the purchasing power of the currency, even then, you know, the whole sort of idea is rubbish. And we have this, I mean, we were talking off air just before we started broadcasting. And I mean, the UN turns around and says they've got to stop raising interest rates. What they've got to do is control prices. Oh, come on. Yeah, I mean, this just shows a level of ignorance at the highest levels amongst the ruling elite, which basically means that, I'm sorry, but interest rates are going to have to continue to rise. And the effect on that, after a very long period of zero and even negative interest rates, is that businesses will start falling over. Markets fall over simply because banks have to reduce, I mean, apart from anything else, they have to reduce their outstanding credit obligations because their balance sheets are so over leveraged. Easiest way for them to do that is to sell down financial assets, which you can just go into the market and do, reduce your commitments in financial markets, which you can do gradually as things like derivatives fall due, and sell out collateral where you've got loans, for example, margin debt and all the rest of it, and where that's secured by collateral, you can liquidate it. And so that's what's going on, and that's why stock markets, bond markets, and all the rest of it are falling very, very significantly. So what this amounts to is a developing crisis. I mean, the title that you referred to actually was a market report rather than in one of my more sort of in-depth economic and financial analysis of the situation. But when I look at, I mean, in your country, one of the private banks, Deutsche Bank, which is a GSIB, I think I'm right in saying that the price to book of its shares, in other words, the value of its shares compared to what they show in the balance sheet is only 24%, 24%, which is option money on the future of Deutsche Bank. And Deutsche Bank is not alone in this. We've had problems this week, very public problems with Credit Suisse, who are trying to go through some sort of restructuring. Similarly, they have a discount market value to book value of around about 24%. Now, you can't raise primary capital at such a discount. I mean, basically, if you're going to do that, then it's a crisis. It's a crisis for the bank because it is a forced dilution of existing shareholders, which otherwise would be completely unacceptable in an environment with a business which is viable. So, we've got these problems. And then I look at the central banks. I mean, the good old ECB and your dear Bundesbank. I mean, they've got so much bonds on their books. What's been happening to the value of these bonds? They've been collapsing with, rising yields. And that is a process which is going to continue. And if I look at the Euro system as a whole, I mean, it's so far in debt. It's going to need recapitalizing. How do you recapitalize something like the ECB? Well, a normal central bank, which has as its principal shareholder a government, is easy to recapitalize. I mean, I can tell you how to do that. I won't go into it because we don't have time to go into technicalities. But just imagine the situation in Germany where, if, let's say, the ECB turns around and says, we've got to recapitalize, who does it turn to? It turns to existing shareholders, including the Bundesbank. So that's going to require legislation in your parliament. And, I can just see, the parliamentarians, the elected representatives of the people, they're going to stand up and say, well, look, hold on a minute. You want more equity injected into your bank so that you can refinance the ECB. And furthermore, your bank is already in deficit because of the bonds you owe and mark-to-market values and da-da-da-da. Okay. Now, why should we do this when the Bundesbank is owed over €1 trillion on target? You can see how it's going to be very difficult, let's just say that, for the ECB to recapitalize itself. And I think, that's apart from the political situation, which is just ridiculous. I mean, it is plainly ridiculous. I mean, why on earth Germany can't stand on its own 2 feet and look after its own people's interests, rather than the interests of the Americans, who are using you as a sacrificial lamb in the Ukrainian situation. I mean, I'm very sorry about what's going on in Ukraine. Don't get me wrong, but this is going to be very tough for Germany. And I'm sure that very quietly, the German politicians would like to sort of come up with a solution to the Ukrainian problem. I'm sure they would be ready to talk, but they're being prevented from talking by the Americans. And us Brits, as the Americans' handmaiden. I mean, all right, we're no longer in the EU, but you can see where Germany is being squeezed in this. German economy is suffering hugely, and I think is going into a slump. It's inevitable, as we see the energy problems arising this winter, as we see food prices and food shortages arising this winter. The amount of discontent that we face as a result of a combination of things, not least of which is this tendency towards printing money, if you like, or printing currency more correctly, and credit in order to resolve all our difficulties. This is leading to a crisis. It's actually no more complicated than that. Where it actually breaks is another matter. And I mean, we saw a tiny bit of that in the UK last week, when we have a new government who decided not to go along with this sort of general international idea that you've got to have greater and greater control over people. You must stop them doing things. You've got to restrict their freedom. You have somehow got to be responsible to everybody. You've got to please everybody, and your economy just goes into long-term decline as a result. That is what's going on in all the major economies. Our new government, I say new administration, in effect, under Liz Truss, is breaking away from that. They're going on sort of, if you like, Hayekian principles. And not completely, because the one thing that they couldn't announce immediately was the necessary cuts in government spending to reduce and eliminate that budget deficit, and furthermore, over time, reduce the amount of government in the overall economy. So, but that's the way in which she is trying to go. And what do the markets do? Well, the markets are driven by Keynesian investors, and these Keynesian investors took fright of this. And it happened at a bad time, because already everybody was getting the hell out of euros, yen, yuan, sterling, getting into dollars. And in markets, they were getting out of longer-term risk into shorter-term exposure. So there was a general flight out of everything into what the Keynesians regard as safety, which is short-term dollars. So it came at a bad time, but it just showed how febrile the whole atmosphere is. I mean, sterling fell to, I think, 105 or something to the dollar, and now we're back up at 114. So,
General bear squeeze. Very volatile out there right now as well. And you brought up the events last week as well. And all of a sudden we saw the US dollar drop quite a bit in a short period of time. Like, is that just a is it just a head fake, or do you see the US dollar breaking down now, and maybe some of the money being pulled out of the US dollar? And we've seen it into probably flow into gold and silver here the last few days.
It's an interesting question. I think without doubt that in the very, very short term, it is a bear squeeze. I mean, everybody is on one side of the boat. They've all got dollars and they're short of everything else. So all you need is for an absence of developments, if you like, for that to begin to reverse. And in a sense, when you see a sharp rally in silver, gold, when you see the dollars trade weighted fall from 115 and change down to 110 something, you sort of think that something different is now happening. Now, could well be that the Fed in a secret meeting has decided, having looked at the evidence, that they've got a soft pedal on the interest rate front. I mean, they would need to get, in effect, the approval of other central banks in order to ensure that there is stability in currencies. But I don't think that would be difficult in forthcoming, because what has destabilized the whole situation is that the Fed has decided it's got to tackle the inflation problem in a very half-hearted way, I should say. Whereas other central banks are being caught napping. I mean, the Bank of Japan is still, I think, negative.
They're still cutting, yeah.
Yeah. Well, I mean, everybody's printing, but I mean, the rates are just ridiculous. And your beloved ECB is on zero. I mean, come on. I mean,
Alastair, do
you
you have a
know,
target rate? Like, I know some of the experts used to say, "Oh, we're not going to go above 2%. Now we're closer to 4." Do you have a target rate in mind? That, of course, like
uh,
if you look at real
Kai,
interest versus inflation rate as well, it should be like 12%. But is that even
Kai,
realistic?
yeah, Kai, it is not the business of any government or any government agency, including their central banks, to set interest rates. So I cannot suggest a target. That is not the point. The point is that because of the way they're managing interest rates, they have them so far adrift from reality that there is a crisis. And the higher rates go in nominal terms, the sharper the contraction of bank credit will be, because bankers, they're not idiots. They see their businesses falling over because businesses have got used to trying to obtain some sort of return at sort of negative interest rates, or 1 or 2% or something. And if they see interest rates rising considerably more than this, they will see their non-performing loans accelerate. They see collapsing market values. They see the collapse in credit in the wider sense than just bank credit. This is a crisis of monumental proportions. And what happens under these circumstances is always you will find that commercial banks collapse. They will need to be rescued by the central banks. It is a primary duty of a central bank to rescue commercial banks. But I look at the balance sheet of the Bank of Japan, the ECB, the Fed, and the rescuers of insolvent banks are themselves in negative equity. I mean, where are we going to go with this?
No, it's just stay on current events. Actually, like what we saw last week in England, and the government or the Bank of England pumping $65 billion back into the system, having to buy some gilts, meaning some fixed interest loan securities, because otherwise the pension funds might have struggled and not be able to probably pay out pensions. Do you see a ripple effect there? Like, it sounds like you're fairly certain that the Fed in the U.S. will continue raising rates. Like, how much, maybe percentage wise, like, does that factor into their decision making? With their emergency meeting they had last week, nothing really came out of it from what I saw. But
No, it was a secret meeting.
it was a very secret meeting, obviously. But how much of a ripple effect do you expect to happen from that move? Like, it's pretty much QE again, for lack of a better term, that we've seen last week.
Yeah, I mean, very definitely there is an effect. I don't know. It's difficult to know whether it's a ripple effect or what we have seen basically is the emergence of a symptom of everything that's wrong elsewhere. I mean, a ripple effect I would define as the sort of thing when you had Credit Anstalt, the Austrian bank, collapsing in 1932. That created another round of banking crises in the middle of the Depression. That is a ripple effect. The systemic risks from a bank collapse spreads. I mean, you're looking at a rotten apple, rotten from the inside, and just because you see a blemish on the outside of the skin doesn't mean that the rest of it's all right, and it will only go wrong if that little blemish spreads. No, not at all. I think this is a far more serious situation. So, yeah, I mean, there's a follow-up to your statement there, which I've rather lost.
No, I'm just trying to figure out, like, the US, the Fed, right? And we talked about off air as well. I read this morning, well, New Zealand just raised rates again, and how is the US influenced by New Zealand? And it's more fuel to the fire in the US. I had a chuckle, actually, when I read that, because I'm not sure how the Kiwi dollar plays a factor in US decision making. But
the only thing I would say about New Zealand, and this is an affectionate statement as far as my Kiwi friends are concerned, is that actually they're on another planet, or they're in another age. I mean, I wouldn't take any lead from anything that a central banker in New Zealand does. It is certainly, I think, very, very likely that, I mean, I would say it is certain that the developments, particularly all the rumors surrounding Credit Suisse, because they got a very big presence in New York. I I think they're one of the primary dealers in New York. I mean, I don't know if that's true. Maybe they are. But no, I mean, if you have something like that, then this is a signal, I think, to any central bank that, there are real problems. What we've got to do is manage the problem, not try and follow a policy. So what we're going to see, I think, is, you can forget quantitative tightening. That's just taken out. That's gone. That's gone. We now have a situation where, if necessary, quantitative easing will be reintroduced, exactly as the Bank of England did. And you said it was $65 billion. It's actually pounds, but the way the rate is at the moment is actually a very similar
potato.
So don't worry. I really do think that the central banks are on crisis watch now. I mean, they must be. They would be neglecting in their duty if they didn't. But this is the problem they have put themselves in. I mean, it's entirely as a result of them trying to manipulate interest rates. This is payback time for that policy, I'm afraid. And we're now in a situation where, under Keynesian analysis, we have the potential for a recession, a developing recession. I mean, you've already got it in Germany in spades. I mean, you don't need to look at the statistics. You know what's going on there. It's very bad news. It's bad news, less bad news elsewhere, but we're going in the same direction. So how do you fit that in with the idea that rising interest rates have got to be introduced in order to control price inflation? I mean, it's, there's so much muddled thinking in all this. And the result is that you've got, you're going to have collapsing economies and inflation, so-called, in the form of rising prices at the same time. And that is, if you like, a central bank nightmare. I mean, it really is. And through all this, they've got to manage a situation where they are themselves are insolvent. Their commercial banking network, for which they bear responsibility, is rapidly becoming insolvent as well. And they've got businesses which are zombies, malinvestments in the Austrian economic term, and businesses which might be profitable, when their borrowing costs are, say, 4 or 5% or something like that. But if we're looking at going to 10%, they're bust as well. I mean, this is a crisis. So what happens, actually, Kai, is they have to make a choice. Do we save the financial system, or do we save the currency? It's that black and white. Now, we've yet to see which way they're going to jump, but I think the events this week and the last week or two have shown quite clearly that the way in which they are likely to jump is to preserve the financial system and not their currencies.
Well, it seems like maybe if I jump in here, because it's something I just read before we went on air here, is that the SWIFT system has been testing central bank digital currencies over the last 8 months and sort of have come to a result for digital banking in the background, which seems like a precipice, or like not a precipice, a prerequisite, or maybe a first step towards a new monetary system. Right. So if we want to play that way, I don't know. Like, it sounds a bit like conspiracy theory, but if we're looking for an exit, it sounds like digital currencies and maybe a reset in that regard. And again, it sounds like a conspiracy theory might be a way the central banks are leaning at this point, just to have an exit.
Okay, dream on is all I can say. I mean, let's look at this practically. I just make 2 points on this one. I don't know about how things work in Germany, but in this country, if you're going to look at introducing something like a new digital currency on the lines which the Bank of International Settlements has been discussing with all representatives and committees from various central banks and all the rest of it, whereby, in effect, the central bank has a direct relationship with individuals. So it's rather like you and I having a bank account with, in your case, the Bundesbank, in my case, the Bank of England. This is a major, major change. Right. So just think about all the testing that needs to go on to make sure the system is secure. Think about the various committees that have got to take decisions to implement this. Think about the legislative program, because it would have to be approved in Parliament or in the Bundestag, in your case. This is not the answer to a crisis. This is something which, at its very, very best, is something that you might implement on a considered basis in calm markets. The second point I would make is that we are actually led by the nose by America and the dollar's hegemony. So we must pay attention to the situation there. Now, I don't think I'm being unduly cynical when I say that the commercial banks basically fund all the politicians' election expenses. I mean, routinely, they give money to both sides. These are turkeys. Are they going to vote for Christmas? Doubt it, because the enabling legislation will have to go through Congress. And I think any politician who stands up and says, I'm going to vote for digital currencies as the solution to get rid of commercial bankers, I think he's just cutting himself off from his election funds. It ain't going to happen. It's as simple as that. So, I mean, don't get me wrong. You will find that there is technological evolution in the way in which we use money, or currency rather, and credit, and our access to it. There will be that evolution. But the idea that there's this whole new idea of central bank digital currencies forget it. It won't deal with this crisis. And I mean, the thing that's interesting is that we've had no comment on this at all, no discernible comment out of the commercial banking system. Why? Because they know jolly well that this is something, this is not something that you criticize at the moment, but you can stop it later. That's the only conclusion I can come to about this deafening silence from commercial bankers.
No, thanks for humoring me in my thoughts there. I find it quite interesting because I'm always looking for the next step, because there's a few guys I've talked to, or commentators I had on the program, that were talking about end the Fed. And I'm always curious, like, what the next steps would be. Right, like what would that even look like? The next scenario, if push comes to shove, right? But Alastair, you obviously head of research for Goldmoney. It all leads back to gold, of course, for you internally, at least at Goldmoney. How is this affecting now the gold price? We've seen I'd call it a rally in the last 2 days. Today we've been, losing a bit. I think that looks like a normal correction to me. But how sustainable is the rally we've seen in the precious metals, mainly gold and silver?
Well, it's crazily oversold. And we're talking about paper markets. Central banks are accumulating physical bullion. And not only that, but when you see what's being stood for delivery on COMEX, I mean, there are enormous quantities of bullion disappearing from COMEX. So, and, I talk to people all around the world, and I'm getting the same story from coin dealers, in the retail industry. And while I would say that the average investment manager is represented by the managed money element on COMEX, is just downright stupid. I mean, it's the only way I can put it. Individuals actually are beginning to pick up that really what they need to get some of their assets out of this collapsing fiat currency system. I mean, obviously, we don't hope, we hope it's not going to collapse, but there is a growing recognition of that. So what we're looking at is a paper market which is bereft of underlying physical. And furthermore, I referred to these idiot fund managers. I mean, basically, they're always short at the bottom and long at the top. We used to call these hedge funds the masters of the universe back in the 1990s, but they're the biggest fools in Christendom. They really are. So, the reason this comes about is their trade. They're not looking at gold as such. They're just looking at a pairs trade. You either buy gold, sell dollar, or you sell dollar, buy gold. I mean, that's the pairs trade they do. And it produces a completely different, if you like, dynamic from anything else. Anyway, so that's what's happening. Now, interestingly, we see the price of gold and silver shooting up in New York, but not in Europe. Now, this confirms that what we're seeing, I think, is short, it's bear covering, if you like, short position closing in the paper markets on COMEX when COMEX is most active. There will come a phase, I think, where we see gold and silver beginning to rise in Europe. And, the other thing, I think, people who are, let's say, investors rather than sensible people deciding that they need some real money. And incidentally, I make the point that in law, real money is not euros. It's not something produced out of the ECB or the national central banks. No, it is not. Real money in law is gold, physical gold coin. That is real money. That is the legal situation. So what people are doing is they're trying to get out of credit into real money. This is a fair trade, if you like, and rightly so, in my view. So, but if we look at the investment demand, if I just call it investment demand, because that is actually what's driving things for most people at the moment. They don't realize that actually they should be accumulating gold, physical silver, not as an investment, not to trade out at a higher price, but basically to spend when they need to spend it, when the valuation of their credit goes to zero or is threatened to go to zero. I mean, that is the whole reason for having gold and silver, physical gold and silver. But the sort of the punters in the market will be looking at the price in euros and saying, well, it's what? It's something like, I think it's about 1,800, isn't it? Something like that, 1,800 euros. I mean, it's around about 5 or 6% below its all-time high. Do you buy things, as an investor close to its all-time high? Well, you sort of think, maybe if it comes back a bit, I will have some. That's the sort of psychology we were dealing with. And that's why Europe is not yet buying it. There will come a point where that opinion changes, and you'll find that Europeans will start accumulating ETFs in particular, that sort of thing, to put in their portfolios. So, I mean, the answer to your question is, I think we're in the start of something. If the Fed turns around, and as I believe it will, start trying to manage the financial crisis, irrespective of what happens to the dollar's purchasing power, or in preference to controlling or managing the dollar's purchasing power, then we're going to see gold and silver go in dollar terms far higher, which is not gold and silver rising, but the dollar falling. And this is the crucial point. What we're doing by buying gold, physical silver, whether it's in coin or bar form, is we're getting out of collapsing fiat currencies. And I think that this is crucial. And I think this is why the timing of this interview, I think, is very, very important. I mean, we've seen this, the eruption of the problem with the Bank of England. We can begin to see the problems in the commercial banking system with Credit Suisse and all the rest of it. We don't have to look very far to see the total rottenness of the system. And it's not going to take very much to get people thinking, oh my goodness, I have got no protection against what they might think at this stage is Lehman crisis Mark II. But it's far worse than that. And as this realization builds, then I think you'll find that the purchasing power of currencies measured in gold will really start collapsing. So I think we are, if you like, on a bit of a knife edge, the edge of a crisis point.
No, absolutely. I fully agree. Alastair, this is a great note to end the conversation. It's been over 30 minutes already. I can't believe it. Time just flies when you're having fun, right? Really, really appreciate your time. Super insightful conversation. I'll definitely have to bring you back on the program. I'll be actually in London last week of November for a conference. Love to have you at the conference, maybe as a guest. We have a booth set up there for interviews. Love to have you, see where things are. That's about 7 weeks from now. Lots of time for things to develop, and we'll definitely know more where things are headed. So much appreciate your time. Thanks so much, and stay tuned for more. Everybody else, thank you so much for tuning in. We were joined by the fantastic Alastair Macleod. He is the head of research over at Goldmoney. Super insightful conversation with him about where things are headed worldwide. I think it was a really, really holistic and comprehensive conversation, I think, about US dollar, gold, silver, and the whole, like, how the world economy sort of hinging together and really hanging on to the last thread here. And we'll see how things play out the next few weeks. And thank you so much for joining us. Follow us on YouTube, follow us on Twitter, and leave a comment. Helps with the algorithm, and we appreciate it, of course, as well. Thank you so much, and we'll be back with more soon.